Deferred revenue would refer to a situation where the company records the revenue after it receives payment. So one common situation that comes up would be when customers make deposits towards something. So let's say that a car dealer accepts a down payment on a Porsche, and if you if you give you $10,000 down payment, they put you on the list, and then when your car arrives, they deliver the car to you and you have to pay the rest. So in this case, a customer is paying you in advance for the product that you're eventually going to sell them. So the cash flow has occurred before the performance obligation. When this happens, the company needs to record a liability because it owes that money to the customer until it satisfies the performance obligation. The way this would work in these little systems is, let's say a customer pays you $400 in advance for sale of an iPod. So your cash would increase by $400, but then your liability would also increase by $400. Then when you deliver the good to the customer, i.e. you satisfy your performance obligation, your liability would go down by $400 and revenue would go up by $400. Furthermore, at the same time, you're going to record cost of goods sold. So you would credit inventory for $150, inventory would go down, and cost of goods sold would increase by $150. So on your income statement, you'll have $400 in revenue minus $150 in cost of goods sold. From an analyst perspective, we want to look at the deferred revenue and look for unusual patterns that may indicate that the company is recording a disproportionate amount of revenue right now. For example, these things generally go fairly smoothly, but if deferred revenue is all of a sudden going down, then the company may have changed their policy or done something that would cause revenue to go up this period and decline in future periods. So we want to be very careful and look at the deferred revenue amounts. And you can see here what's called a deferred revenue roll forward. Deferred revenue is a liability. And here you can see it's going up when the company records more deferred revenue. In other words, it collects money from customers in advance, and it goes down as it recognizes revenue. And so this would explain why the deferred revenue account liability would change during the year.